Welcome back, Dividend family. So today we're actually going to be doing something a little different. We're going to be looking at some other M1 Finance portfolios from a couple different members from my Facebook group, which if you are not a part of yet, I'll have a link down below for you to be able to join. It's entirely for free, and we just talk all things M1 Finance and investing all together. Now, what I want to do is kind of just take a brief look at all these different portfolios, kind of get an idea of, where this person is wanting to head, and kind of give them a heads up of how the portfolio is looking across the board. Now, if you're not too familiar with M1 Finance, this allows me to actually see their portfolio and some of their percentages, but not their actual dollar amount. So all of that information is, of course, going to be unseen for myself and for you guys as well. If you are somebody who's going to be interested in this, make sure you join in on the Facebook group so you can hopefully get into the future episodes if we continue to do more of these videos, if you guys like them. Now, before we get into the first portfolio, this episode is brought to you by Earnest, which is the student loan refinance company. If you need to lower your interest rates, you can do it entirely for free with Earnest in the link down below. The coolest part is they give you a nice bonus for using my link, and it helps support out the channel so I can continue to do free stuff like this, and then you can use that extra money to invest in the market or pay off debt or anything else you want to do. All right, so now what we're going to do is actually go and look at the very first portfolio here. And before I show the portfolio, I do want to read kind of the little message that they sent me when I asked for this information. All right, so this next one here says, "Hi, Dennis. Thank you for choosing me. I'm 21 years old, and I'm currently a senior in college. My goal is to find a job, most likely in human resources, and save enough money for a down payment on a house, as I'd like my parents and I to pay towards something that will be ours. I hope to then buy a building or another home to rent it out in the future." Awesome. I really do like that. It says, "In terms of my M1 account, I have a taxable account, about $1,030 invested, and a Roth IRA, about $1,530 invested. I'm currently working as a Spanish tutor at my school, so I plan to make small contributions each month towards my account, 15 towards the taxable, 35 towards the Roth IRA. I wish I could contribute more, but I also understand I can't throw everything into investing since it's really not a high-paying job." And their question was, should I add an international fund? I've seen that is recommended for diversification, but I've looked into it and it isn't really high returns. So I have links to both of their Roth and their regular taxable. So let me move some stuff around here so that way I can look into these really quick and then kind of give out some information on what I think about with these two different funds. Again, if you guys are interested in me checking out your portfolios, just go ahead and make sure you join my M1 Finance group, and then when I post something about maybe doing a future video like this, you guys can chime in, and then I can get that information from you guys. Now, we're going to do these pretty quick since there's two of them. So, of course, this one is going to be their Roth IRA. By the way, I'm glad that they're adding more into their Roth than their taxable, just because we want to make sure with our Roth we have more time to build up for the retirement account. So we can see in the 1 year, this has grown 61%, fantastic. And in the 5 years, it's grown about 49%. So obviously with that dip, it's still hurting. So let's take a look and see what we have here. 18 holdings, 1.5 dividend yield, and then 0.03 expense ratio. So I'm seeing a pattern here with a lot of the portfolios I'm seeing because we have VOO, VTI, and then VIG, which is the Vanguard Dividend Appreciation Fund. There is a lot of intermingling between these different funds. So there's obviously some things when it comes to that because of the fact that you are investing in a lot of the same things, just splitting your money a little bit further across the board, making it harder for each individual fund to get a lot of the money as the deposits come in. So for me personally, I like to have just the one ETF, and that's what I stick with because I am okay with not being as diverse as like the VTI. This has like 3,000 something funds in it, but then I do something closer to like the Vanguard S&P 500, but I do the VOOG version, if I can add a little G there, and that has, I think it's the top 250 of the 500 funds, giving it a lot more growth opportunity across the board. So just something I personally do. And then the SPY is also similar to this fund right here. So you're quite literally just doubling in on those ones there. Now, what I do see here that's a little different, of course, is that we have like Square and we have Zoom. I don't know why I aligned them separately and opposite, but we have those two right over there. Smaller portions of the portfolio, but gives you opportunity for some cool growth. And then we got like some companies like Target, Pepsi, Coca-Cola. These ones are a little bit more, solidified in their sectors, and they're mainly focused on the dividend side of things when it comes to payouts. We got Home Depot, which is fantastic. And then we got like Tesla, DraftKings, Google, Microsoft, and Amazon, and Apple. All these companies are fantastic companies for a lot of growth. Obviously, they've all been doing well for the majority of the time. They've had some downturns recently when it comes to just tech, but the cool thing was if you bought during the downturns, that means you got some really good values there. So across the board, since this is a Roth, obviously you can always adjust things without the worry as long as you're not withdrawing. Obviously, you got a bond fund here too, which is great for retirement depending on how close somebody is to retirement. I personally am waiting on doing a bond fund until I get much closer to retirement age. So to answer your question before we get into your next pie here is you asked about international funds. I personally don't do international funds. I'm kind of in the same boat with you. The returns are nowhere near the same as US funds. So I personally have stuck away with them. I know some people talk about that, especially with like Dave Ramsey mentioning international funds. And I've done that for a little while before too. And I just finally got out of it because unless I'm buying into individual companies that are international, I just don't see those really good returns in comparison to U.S. companies and the rate that they have as well. So I'd rather make more money and just be more diverse in my U.S. funds rather than trying to invest into international and not get that same return. All right, so let's go ahead and take a look now at the other portfolio here. So this one is the regular taxable account. This one has 70% growth in the last year. This one has 16 holdings at 1.48 and expense of 2.0. So it looks like it's pretty much the same exact fund, but just on their taxable rather than their retirement. Now, the nice thing is since we don't have to go through all of these individually, because I do actually only bring these up once I start recording, so everything is kind of in real time when it comes to my reactions. It's not necessarily a bad thing to have pretty much the exact same thing for retirement as you do for your taxable account. Just keeping in mind that everything is obviously all the same. So you're going to have, the same downturns in the market as the same upturns in the market as well too. Obviously, if you're saving up to be able to put towards like a down payment, that is fantastic. That is really, really great. My only thing with a taxable account being used for something like buying putting a down payment on a house is making sure that you have enough allotted time to be able to take any big dips in the market, right? Because let's say you invested in 2018 to say, hey, in the next 3 years, I'm going to go ahead and buy a house. Well, if you wanting to buy a house happened to be around February, March of 2020, that would have been a really hard take because all of a sudden you're actually going to be down on your overall portfolio from 2018 numbers because of how much the market dropped. But if you had a longer spread around like, let's say 5 years, then you would not see that big of a dip across that 5 years typically. You would see a lot more of the returns if markets did go down like they did in early 2020. Now, one thing I would say too is for me personally, if I'm investing to hold for, some big purchase, I would probably go less and less into riskier funds, companies like Zoom or Square or Tesla, only because I don't know how those individual companies are going to do in comparison to something like Pepsi or Coca-Cola, but you're not going to get those same kind of results when it comes to growth. But I wouldn't want to risk that much money when it comes to the principal, so that way I can use that money for buying a rental property or, a house for myself or whatever the case may be. So just something to keep in mind when going through that process. All right, so this next one here says, I'm 32 years old. My goal is passive income. I want to one day get up to $100,000. We could probably get to about $500 or $250 a month. As you know, I don't make a whole lot, so I invest what I can. I also have a very small ETF portfolio that I invest about 80% into the dividend growth and 20% into the total market one. And that when I have 90% VTI, 10% VX US. This is a taxable account, so yes, I have been wondering if I should have my real estate investing trust in a Roth or something down the road. So let's go ahead and load up this portfolio and then see how we can answer that question for you. All right, so this right over here, we can see this is the dividend growth portfolio. In the last year, we had about a 5% growth. And then here in the 3 years, it's about 26%. And then 5 years is 74. Again, this is not their own money. This is just hypothetical if they invested 5 years ago with $100. So here you can see they have just one overall slice, which is essentially all their holdings. So we're going to click in here. We have 33 holdings. Now I do know this person a little bit more because they've been in my M1 Finance group since pretty much the inception of it. So they have 33 holdings, but they used to have quite a bit more. So it's nice to see them cutting down a little bit there. They have a dividend yield of 3.29% and a zero expense ratio, which means they are pretty much invested into individual stocks. So we can see here, we got the likes of like Pepsi, Johnson & Johnson, 3M, McDonald's, JP Morgan, a lot of these very strong companies that have been around for a long time. And these are definitely some of the reasons why his dividend yield is much higher than, some of the other ones we've seen earlier. But across the board, we're looking at some really solid companies. We got Realty Income for your monthly dividend, which is fantastic. We got McDonald's, like we mentioned. We got AbbVie in the health. We got Visa in financials. Home Depot in retail. I couldn't say that for a second. We got the tech companies, of course, Microsoft and Apple. We got a lot of variety, and that's what I like about this portfolio. I could tell you right off the bat, this is probably a portfolio that looks very similar to mine, to be honest, as far as the different diverse companies that you have in here, which is just giving you a lot more freedom to be able to, have the market going up and down and not worrying as much, because if one sector is going down, sometimes you have other ones going up, but if everything's going down, it's going to go down together regardless. Just something to keep in mind, obviously. So your percentages are looking pretty good. Essentially, the highest you have is right over here with Pepsi, and obviously a few other ones here at 5%, and then the lowest one you have is a couple of them here at 2%. So that's good. So you don't have a wide range, so you don't have a one fund weighing way more than any other. So yeah, you can see that looks really good there across the board. So this is essentially, you put your own ETF together with the companies you find most valuable to you that are going to stick around. And the nice thing is, with 33 companies, if one of these companies just goes down over time, it's not going to be a big effect on you, because one, the percentage, but two, because of the diversity that you have with this portfolio. So honestly, Joel, really, really good setup that you have here as far as what you're going for. Obviously, you're not going to get the most growth with some of these older companies like Coca-Cola or Pepsi and that kind of light, but you are going to have a pretty solid dividend yield, so that way you can have that income coming in over time. And even if you can only invest small amounts every month, keep going, right? I know you and I know about this and talk about it, but with everybody, keep going. If you can't do a lot, that's fine. Every little bit counts. Being consistent when it comes to investing is a big part of investing that people don't ever talk about. Yes, you don't know a lot of things possibly, or, whatever the case may be. But if you keep on investing and stay consistent, that is going to get you to your goals, right? Starting with $10 a week, which is what I did. And then I started moving up from there, learned a lot more, and then felt more comfortable to keep on investing. Check out my video right over here to keep on watching more. My name is Dennis, and I will see you guys in that next video.